In the last section, we looked at some pre-tax measures of cost of debt capital. Let's look now at some post-tax measures. The issue with our pre-tax cost of debt capital is it's not considering how debt may reduce our tax expense, and that's a good thing, right? Right, because that's gonna help us boost our net income. And the way to suss this out, to see how our tax expense might be reduced, is to look on the income statement. So if we want to look holistically at a company, we'll see in just a second that debt interest within reason can really benefit an entity by reducing its tax, which in turn is going to mitigate the impact of interest payments on a company's net income, which is what we all care about, right? Let's see how this works with another straightforward, hopefully, example. We've got here Superco, okay? And what I'm doing here, and I'm going to start doing this a lot for the rest of the semester, I'm going to be looking at an entity under two different conditions, kind of like we did with the Cowboys and Conservatives. I'm going to look at how things would be without any debt and how they would be with debt. Okay, so here I'm looking at what's going on with the debt itself. If there's no debt, clearly nothing. Tax rate is 50%. That's going to be unaffected by whether the company has debt or not. So in the with debt case, they have $1 million outstanding in debt. Their interest is 10%, so they're paying annually $100,000 interest on that. And now let's go down to the income statement. So revenue, of course, is the same in either case, as things like SGA expense are going to be the same. What's going to be different is the interest expense. So we get down here and we see that the case with debt, the company does have this additional expense of 100, right? Using my K units here. And that's going to mean that its earnings before tax is 100 less than it would be with no debt. So you see we have 750 versus 850. Okay, and then we go ahead and we take the tax rate. So that's 50% of EBT in this case. And I'm saying here that the taxable income is equal to earnings before tax for this company. I'm just saying that so those of you in the accounting police won't try and ding me for that. Okay, and so we've got our 50% of each of these and we subtract that and we get our net income in each case. And here's the really cool thing, okay? Even though the expenses with the debt went up by 100,000, the hit to net income was only 50,000. And that's because of the tax shield effect. This is what we call the tax shield effect. And the way it works in general, I've made this red because it's an important equation that you should definitely know and hopefully come to love. So the hit on net income for a company, if it takes out a bunch of debt, is going to be 1 minus the tax rate times its interest expense. And you can see clearly that's less than its interest expense because we have 100% minus whatever the tax is here reduces that number and the hit on net income. And remember, we did see this. We didn't really know what we were doing so much or why at the time. But when we were looking at the Cowboys versus the Conservatives, when we were looking at financial leverage, when we were considering ratio analysis, we did actually see this effect. So let me just put in a new column here for us for delta. So here we have 9.0 increase in expense for the levered version of this company, which was the Cowboys, versus the unlevered version of the company. But because of this tax shield effect, the hit to net income is only 6.75. So the expenses went up by 9, but net income only went down by 6.75. You can get this number just by working out all the math on the income statement, but we could also use our little formula over here, 1 minus the tax rate times the interest expense. So we need to know what's our tax rate here. So it's 25%, okay? So the 6.75 is equal to 1 minus 25% times our interest expense, which is 9. Okay. And you should double check me on that, but again, I think you're going to see it works out just fine. Remember, very important about this was that this leverage had a huge effect on ROE, right? So the ROE with no debt is equal to our net income divided by equity, right? And that's equal to 15 over 100 equals 15%. And our ROE with debt is equal to 8.25 over 10, and that's equal to 82.5%. So the tax shield leverage, and particularly the tax shield portion of leverage, helps us a lot to get this juiced up ROE if we do have a levered company that is profitable. If we're not profitable, it's going to make things much, much worse. Okay, so now let's look at some generalized measures of pre-tax and post-tax cost of debt capital. Okay, so in general, our pre-tax RD is going to be the IRR of the entity's cash flows for debt projects viewed in isolation. Okay, so that's going to be with no income statement consideration. Okay, and our post-tax RD, this is another important equation here, is going to be it's always going to work out to be 1 minus the tax rate times our pre-tax RD, okay? And this is what people call the net cost of debt capital. Okay, so net equals post-tax, because net means after everything that needs to be considered. Okay, and we're going to start valuing entities using methods other than the balance sheet valuation method, and we're going to use our post-tax cost of capital for that. And also another thing to note is if we have something like an LLC or a REIT which doesn't pay income tax, in that case, the post-tax cost of capital is going to equal the pre-tax cost of capital. And then just quickly here, let me also throw in that post-tax is going to be always less than or equal to pre-tax. Maybe a better place to put that would be right up here. And you can see that because clearly of this equation. This is some number less than 1 times the pre-tax number, so it'll reduce it. All right, so now that's pretty much all we need to know about the cost of debt capital. Let's see if we can go on and do the same type of analysis with our cost of equity capital. So in general, our cost of debt capital was pretty easy to estimate. We have some pretty clear methods that we were able to use above, and they were all related in one way or another to contractual terms. So as long as the future is going to look kind of like the past for an entity and it's not going to default, the estimated RDs that we've come up with are really correct. So that's great. The cost of equity capital is a completely different animal. It's usually very difficult to estimate. The reason is we want to understand the growth rate of an investment that has no contractual terms, right? That's the key point here is we're just flying with expectations, not contractual terms. So the cost of equity capital for an entity is almost always going to be a rough estimate. Even for the example that we did in the very beginning of this chapter, that was a very rough estimate because the management of that startup company wasn't promising any of the things like the dividends and the repayment of $1 million at the end of 2 years. That was their expectation if their black box company worked out well. Okay, and in general, the cost of equity capital is going to be directly affected by industry conditions, management issues, macroeconomic issues, etc. So with that said, there are a bunch of common models for determining the cost of equity capital for an entity. So here's a great survey that was done of cost of equity capital models used by investment banks and hedge funds, done in 2010, but still very relevant today. So if we look at the results of this survey, we see that most investment bankers and hedge funds were using and still are using the CAPM method. That's the capital asset pricing model that we looked at briefly in a previous chapter. Another method, which is fairly common, is historical average returns. That would be including dividends, and then you just apply the future. It's going to look like the past and project that forward. There are various modified versions of the CAPM model which aim to improve it, so people use that. And this doesn't add up to 100% because some of the firms clearly are using more than one method. And then folks can use what's called the Gordon growth model, which we'll get to later. And I love this, whatever investors tell us. So that's the kind of firm that you probably don't want to go work for. Okay, but one thing that's very clear here is that CAPM and modified versions of CAPM are used far and away more than anything else. So for that reason, we've got to be familiar with at least the basic CAPM model. So now let's take a deeper dive into the CAPM model. So CAPM stands for the Capital Asset Pricing Model, and here are its key features. It is the best known, most widely used, as we just saw, model for estimating equity cost of capital. Okay, it can also be used for RD. It's not as common, happily, and we're only going to use it for RE. Okay, and other thing that's very important about this model is that it's known to be limited in its accurate application and generally inaccurate. So here are just a couple of good quotes explaining this. So this is from Ivo Welsh, who has an awesome corporate finance book. He's from UCLA, and this is an MBA level book, but it's really great. And he says, among other things about CAPM, despite its wide use, the evidence in favor of CAPM's modeling accuracy is either weak or non-existent. And this is so sad. But I tend to agree with him. I think he's right. And then there is a great academic paper done by this group in the IEEE Journal of Selected Topics in Signal Processing. This is a group of super quants. Okay, they use physics and high-level math to look at all sorts of stuff, applications in finance and physics and bioengineering and everything else. So they turned to finance and looked at CAPM, and in their paper, Empirical Evidence Against CAPM, they said, among other things, there's economically and statistically significant evidence contradicting CAPM in the US stock market over the past 40 years. So that's a fancy way of saying there's a lot of evidence saying it just doesn't work very well. Okay, so in spite of those caveats, okay, we gotta be familiar with it just because it's used so widely. Okay, so assumptions needed for the CAPM model. Again, I don't need you to know what all these are, just need to know there's a whole bunch of required assumptions. That's all I need you to know about this page. And with that, with the above assumptions, the CAPM model works like this. It says if we're using a DCF method like NPV to evaluate some equity project called J, then we'd say the NPV of this project J is equal to the sum of the discounted cash flows, just like always, where we're discounting the cash flows with cost of equity capital for project J. So let's see what else I might have missed here. I goes from 0, as always, with the NPV to the number of cash flows. So we're including every stinking cash flow in the project here. And TI is when that cash flow happens. And the cash flow itself is going to be just as usual. No change here. Project risk adjusted cash flows. And these are going to be cash flows to the owners. Not cash flows to owners and lenders, but cash flows to just the shareholders. And NPV, of course, is the net present value for this project, which would be owning shares of this company to the owners. And the RE is the opportunity cost of capital that matches the risk adjustment, the project risk adjustment of the cash flows. So let me just put in project there. And given all that, then we say that the opportunity cost of capital for this project, which is typically going to be buying shares in this company, okay, for this project J, to owners, not to debt holders, but to shareholders, is equal to our risk-free rate plus the difference between our market rate and our risk-free rate times this thing called beta. And this is the same beta we have looked at in previous chapters. So this equation is called the CAPM equation. Happily, it's pretty simple. And let's make sure I've got everything covered here. So we have RE comma J is the appropriate cost of equity capital for project J. It's what we want to use. So it's going to be the discount rate that we're going to use with our NPV equation for owners of a company. And RRF is the same RRF that it's always been for us. It's the rate of return for risk-free projects of similar duration, which we're going to measure. We've always been measuring risk-free risk and risk-free rates by treasury bonds. So we'll continue to do that. So I'll just put here same as usual. RM is the expected value rate of return of the market or industry. Okay, so that's like, i.e., average return of SPY, etc. Okay, so this would be where we'd take our 30 years of returns of we'd call the stock market well represented by the SPY ETF. We'd take 30 years of returns, take the average and return, and that would be our RM. And our beta for this project, beta J, is the same as it was in the previous chapter, the correlation and amplitude of project J's returns relative to the market or the industry returns as measured by same linear regression that we looked at in a previous chapter, saying the return of stock J is equal to alpha plus beta, that's the slope, remember, times the return of the market. And again, we would have 30 years worth of data to try and estimate this line, estimate alpha and beta. So you can see this is not going to be an alpha-focused method. Only beta comes into this here. So let's think carefully about our risk components in our CAPM model. So what risks do we have? We have risk-free risk measured by RRF. We have broad market risk, something like S&P 500 return risk. So that would be the equivalent of, what's our risk return going to be if we buy the spiders to represent the S&P 500? That's represented by RM. And then that correlation of amplitude of the project J, and project J is going to be something like stock of company J. Let's make that a little clearer. Stock returns of company J to the returns of the market or industry, just like it was in the previous chapter. And then, of course, project-specific risk is still measured in the projected cash flows. So there's one important adjustment we need to think about, just a little bit we need to know about to the basic CAPM formula. It's true because it's found true empirically that the beta, the slope in this regression of returns of stock J to the market, it increases with the financial leverage of company J as measured by, if we measure leverage by debt to enterprise value, which you remember hopefully from ratio analysis is our debt divided by debt plus market value of equity, okay? And because of that, just looking at the equation, the CAPM equation, as beta gets bigger, all else being equal, the cost of equity capital is going to get bigger. Okay, so this clearly means that the cost of equity capital increases with increasing leverage. And that makes sense because we've seen from the example of Trump's properties in Atlantic City and also our Cowboys versus conservatives, the more leverage you have, the more risk of going bankrupt you have. Okay, so you don't need to know the gory mathematical details, okay, but I just want to show them to those of you who are interested. This is pretty well modeled actually in a thing called Hamada's equation, and the key thing to note here is that beta is increasing as this debt to enterprise value ratio increases, where we have beta j comma u is the beta of the firm if it had no debt, and that's called the unlevered beta, and TR is the tax rate. So anyway, you don't need to know the gory details of the math. I just wanted to show it to you how it is modeled, and this is actually a pretty reasonable model. Don't need to know this equation, but you do need to know this concept. All right, so now let's see if we can understand how to compute our inputs to the CAPM model, and then let's just go ahead and do an example. So RRF is just the rate of return of our risk-free project, similar duration, and we're just going to use forward yields of treasury bonds. We can just look these up at Bloomberg, Google Finance, or etc. Okay, and the return of the market, that's our expected value return of the stock market. Okay, and the way we'd want to do that is very similar to what we did in the previous chapter. In fact, exactly the same. We'd just say, well, let's represent the market, the stock market, by the S&P 500 index, and let's consider 30 or more years, and we'll just take the average return, and that will be RM. And so that's pretty straightforward to compute as well. And another thing to note is that the model is really focused on the difference between the expected market return and the risk-free return, okay? And a lot of folks who use CAPM just try and estimate this directly instead of estimating the market return and then subtracting here. So this is important because this is called the stock market risk premium over the risk-free rate, okay? And because so many people use this instead of computing this individually and subtracting, it's good to know what people think of it and how they use it. So a lot of people have estimated this risk premium of the stock market over the risk-free rate. And the latest set of examples I have for you, I poked around all over the internet in 2008 when GDP was 5.2%. So I found one of the head analysts from Goldman Sachs suggested to use a risk premium of 3%, and a prof at Wharton suggested 4.2%. An analyst at Merrill Lynch suggested 1%. And an analyst at Lehman, yes, there is a Lehman successor firm, suggested 0.5%. And Robert Shiller, who's a Nobel-winning laureate at Yale, suggested 2.4%. And at the time, the Columbia Business School in their MBA program was using 5% in their intro corporate finance course. So just, you can see there's a huge range here, and hopefully you're starting to get out of this that CAPM might not be so good because of all these problems, these huge ranges, which one do you use, et cetera, et cetera. And then how do we get the beta? The beta we get doing our linear regression exactly the same way we did in the previous chapter. We just get a bunch of 30 years worth of returns for the market represented by the S&P 500 or something, and 30 years of returns for a stock we're thinking about investing in, and we do that linear regression, and out of that pops alpha and beta. So the nice thing is that clearly we can compute all of these things. This is maybe the squishiest, as we saw, but at least we can compute all of these quantities one way or another, or we can just directly steal someone else's estimate for them. Nothing wrong with that.